attempt. Yeah, it's kept our attempt here as the student. All right, so let's go back through, and I'd love to just hit a good smattering. Everything's going to be on the final. So if we recall, if you don't recall, here we have Chapter 6, just the FIFO portions. Whoop. We have Chapter 7, and we had 2 weeks of that. So there's Chapter 7, more the standard direct materials, direct labor variances, and then Chapter 7, the overhead and mix/yield variances. And then we had Chapter 8, get a week. Thank you. There we go. I have been writing this out. I haven't been like typing an email or something. And then we gave a week to Chapter 10. So we have 5 different, we have 6 different sections here. And when I talked about final exam, I believe I gave out the basic idea. So like a combined Chapter 6s and Chapter 7s, the Chapter 6 and Chapter 7 weeks, but it's largely the same setup with 4 to 3 questions per week that we spent on these sections, basically. A little slightly higher weighting for these first 2 because they're 2 weeks and they get 7 questions each. I think that is reflective of what you spent time and effort on, though. So I want to reward that effort. And there's something to be said about by giving those the 4 instead of Chapter 8 and Chapter 10, a 4, if I have to give some weeks 4 questions, that reduces the diversity of knowledge that you have to know. One of the great difficulties of the CPA exam, the phrase that they have is you have to have your knowledge a mile wide, but only an inch deep. That's often a critique, but the idea that you have to have your knowledge a mile wide for the CPA exam is very accurate. You have to have a lot of different topics at your disposal for those questions. And so maybe de-emphasizing these 2 a little bit helps you focus more on the bulk of effort on these right here. Each question is worth 10 points. And like I said in the exam here, I actually, not thinking, put it at 25 questions at first. If you looked before I sent this announcement, it would have said final exam, 25 questions, final exam review quiz, 25 questions. And I put the points per question accordingly to make it 200 points. Then I realized that was not consistent with the midterm. And I think I had even committed to you all that the midterm and the final would have the same setup and number of questions. So I made these two final exam and final exam review quiz to be 20 questions, and this is the breakdown right there. 7 plus 7 is 14, plus the 6 here is 20 total. So let's go through these questions. We're going to start with, they go basically in order, and that is a test taking thing you can do is say, well, where about in the exam am I? To kind of tell yourself, what should I be thinking? What part of my notes, my note card, should I pull up, or note page should I pull up and look at? Or what part of my memory should I pull up? What is the likely chapter and information here? All right, let's just start out here. So we have FIFO and TEU with regard to conversion costs. That's the first question. So we have FIFO, TEU, conversion cost. Now, under FIFO, TEU equals units completed less beginning WIP equivalent units plus ending WIP equivalent units. So let's go through this fact pattern to gather the information we need to get this units completed to figure out TEU. So we have 400 physical units in the beginning of the period. We started another 46,000, and we had 200 left over at the end of the period, which means our units completed had to be 46,200, which makes sense. 200 unit difference there to get the beginning to ending WIP differential. Let's also put down our percent completes here, specifically for conversion costs, because that's what the question is about. So all raw material, who cares? Beginning WIP is 35% complete with respect to conversion costs, 0.35, and ending WIP is 0.75. Oop. All right, so our TEU now, if we just follow this equation, has units completed minus beginning WIP equivalent units, which is the beginning WIP units times their percent complete, plus the ending WIP equivalent units, which is the ending WIP physical units times their percent complete. Hopefully it's ringing a bell. So this is coming back to you. Somewhat, maybe. And so that should be our TEU, and that is one of the answer choices, so we're going to click that one. Okay? Let's move on. This is a cost question. Great. So there are like 3 steps in process costing before we can get our costs from the top, the dollar amounts in beginning WIP and incur this period, down to how much goes to units completed and transferred out, how much goes to ending WIP equivalent units. We have 3 steps. One is to calculate TEU, which is going to be our denominator for the rate. Second step is to calculate the rate, which is what this question asks us. And the third step is to apply cost. So great, we did step 1 in the first question. Now we're doing step 2, because it's asking for cost per equivalent unit for conversion costs again. So this is FIFO. Rates, specifically for conversion costs. Now, total costs in FIFO is just current period costs. Don't mix in your weighted average knowledge, which was necessary for the midterm. Weighted average, we put both the beginning WIP costs and the current period costs in the numerator as part of total costs. Total costs is in the numerator for the rate under FIFO is just the current period costs. And it looks like I already calculated for you total equivalent units. So what do we put in the numerator for this question? Would be our numerator for the rate here. Oh. Those wheels turn. These two together. Under weighted average, that would be correct. We would want to put the beginning WIP costs and the current period costs added together in the numerator. Under FIFO here, we're just going to include the current period conversion costs. What's the denominator? Maybe it's up. The 99,000 TEU here, right? Okay, good. All right. Good mental rep to think through it. So that, make sure that that's not rounding it off for me. 1095 is what it says. So that should be our conversion cost per equivalent unit rate. Should be right here. In fact, I think this is what we would get if we included the 99,000 in the numerator as well, as if we were in weighted average. It's there, right there, tempting you. And I think these two are if you incorrectly go with direct materials somehow, if I'm not mistaken. But at least they look like that. Okay. All right. Well, we got time. If there's a little rusty to pop a question there on you, it's okay. We got some time to refresh, kick the rust off, work the rust off, whatever it is. All right, we'll skip over this one. We'll go back to it. We want to get to that's good applying cost question, ending WIP balance. And that's a good applying cost question, the total cost of units No, that's ending work in process as well. We got real lucky here. We didn't get any units completed and transferred out costs. Well, we'll make sure we do one of these. Anyway, but let's do an open answer because those are fun, right? Okay, so we are now at step 3. Although this question is more comprehensive, it's actually asking us to go through 1, 2, and 3. There's no, it's not. Rewind that. Sorry, I just saw. We've been given the rates. Okay, so do you need to calculate TEU at all? I tried to give you a grammatical hint. It leads you to no, you don't. Not at all. So yeah, I've already done that because the TEU was necessary to get these rates. That was the denominator. The TEU with respect to direct materials was the denominator to get this $24. The TEU with respect to conversion costs was necessary to get this $16 right here. So great. This one is going to be just step number 3 for us. Other ones do ask us to go through steps 1 through 3 altogether. This is a FIFO apply costs question. All right, so we have 2 rates here. In fact, we need to use both of them. It says total cost, so we'll need to use both the direct materials rate and the conversion cost rate. So we have 24 DM rate, and we have 16 is our conversion cost rate. So that's dollars per equivalent unit. And we need to figure out the cost in ending work in process. All right. What do you think we should do about this? Any steps you remember? Pull out beginning WIP. We would need to do that if we were doing the cost of units completed and transferred out. Yeah, we have to get a special work done or equivalent units completed with this period's work. That's when we have to pull it out, exactly. This is the total cost of ending work in process. And it's the same for FIFO and weighted average, if that helps. So the only procedures you have in your mind, the only algorithm you have in your mind is how to do this is going to be the correct one, if you have one that you can recall. No, dollars per EU. Okay. Let me ask this right here. We're going to need ending WIP equivalent units with respect to direct materials and with respect to conversion cost. Now there's something we haven't talked about in the question. If you've read through the first paragraph there, that tells you something you need to know about ending WIP equivalent units with respect to direct materials. What is the ending WIP equivalent units with respect to direct materials? How would you calculate that at least? They're 100% complete, right? Okay. So you're going to take the units in ending WIP, 235 times 100%, which gives you, again, 235. Great. So that's excellent. Yeah. What about ending WIP equivalent units with respect to conversion costs? Perfect. Thank you. 235 times 0.54. Just pulling out the ending WIP physical units times the percent complete with respect to conversion costs. So we've got our 2 equivalent units. We're going to multiply these rates by the equivalent units to get direct materials cost in ending WIP and conversion cost in ending WIP. You sum those together. No, bet it did too much. Yeah, it always does too much. You sum those together, and that should be our total cost for ending WIP. Okay, any cells you want me to open up? See how I did them? Yeah. This one right here. I multiplied the rate by the equivalent units in ending WIP with respect to direct materials. Okay. I just copied that down to the same thing to conversion cost, but with the conversion cost rate and the conversion cost equivalent units with respect, or in ending WIP. Okay. Great, let's copy that over. See if we got that answer right. At the end, we'll see. Let's move on from chapter 6. We can come back to chapter 6 stuff in a minute. Let's make sure we get full coverage of all the, not in a minute, it'll take a little bit, but all of the kinds of questions, generally speaking, kind of refresh our memory of the last few weeks. As we get closer to the bottom of the exam, it'll be more and more recent, so I imagine less and less rusty. And so here, we're looking for the firm's direct labor quantity variance. So let's go up here. This is our kind of our chapter 6 section. This is our initial run through. We'll see if we have another tab. Maybe we will, maybe we won't. Go down to chapter 7. And this is direct labor quantity variance. All right. So for the quantity variance, direct labor, any quantity variance rather, it is the actual quantity times standard price minus the standard quantity times standard price, where standard quantity is from the flexible budget, meaning at actual finished goods production. Or you can restate that. Quant variance equals, in parentheses, AQ minus SQ, all times the standard price. So we need 3 variables total. Okay, if you look at it this way, you can look at each product here, AQ times SP, as our quasi-budget box, right in the middle of the mountain range. And full standard over here is the other SQ times SP. That's right over here. So we might have, let's say we have, I don't think I pulled that trick on you here. I think we're going to have to go with 1, 2, 3, figure out what AQ, SQ, and SP are. But remember, some of the questions, they give you like, well, this is what the quasi-budget, or this is full standard, or whatever. They give you this as a whole, and then you have to use this. It's easier to use this equation than the algebraically reordered one. So let's put AQ, SQ, and SP. So our actual quantity in direct labor, are we looking for actual quantity purchased or actual quantity used? Or is that a trick question? With direct labor, is it legal to have a different direct labor quantity, actual quantity used versus actual quantity purchased? It's not legal, right? That's called kidnapping. Okay. Yes. Callbacks. So we want just actual quantities, actual quantities, actual quantity. But you might have those in your head because in direct materials, we do purchase them, set the direct materials in a warehouse, and use a certain number of them later. So actual quantity purchased and actual quantity used this period are going to be different in direct materials. With direct labor, you purchase time from people. So when the time has elapsed and you purchase that time, that is the time you've used. All right, so standard actual quantity here. Let's see. Actual quantity. The actual results this year are different from the static budget. We produced this number of actual finished goods units, which is going to be important when we get to the SQ here. We used 22,000 direct labor hours. That's our actual quantity used. Great. Up here, I saw the standard price. Standard price is $12.50 per hour. Copy that over. And standard quantity. All right, well, what we have here is information about the static budget. So last year, we created a budget. That would have to be the static budget because we created it last year. We didn't know what actual production was. We budgeted that we thought we produced 25,000. That's our static finished goods production. That's our static volume. And in that static budget, the firm expected 20,000 hours of direct labor. So implicit in that is that for every finished goods unit, we expect 0.8 hours of direct labor. So SQ per unit is 25,000 units. No, equals 25,000 units divided by 20,000 hours expected. So back when we were in the room hashing out the static budget, either whatever it was, however that happened, we said, well, if we expect to have 25,000 finished goods units, because that's our prediction, then we must have, I want to put them up opposite way. We must have 20,000 hours of direct labor. So yeah, somebody came to us, management came to us and said, static volume. I'd expect marketing came to us and said, we can fill 25,000 units of demand. And we said, oh, well, our expectation is that that's the static quantity per unit. And so we expected 20,000. That was our static budget, standard quantity. Does that make sense? I just went back through to make sure everything ties. If you want to check your logic and on the exam or whatever, feel free to do that. But this should be our SQ number. And so given that SQ per unit number, given that standard quantity per unit, and our actual production, our actual volume here of 29,700, we would have expected to use a standard quantity of 23,760 direct labor hours, direct labor units. So comparing these two, just these two, are we likely to have a favorable or unfavorable variance? I'm hearing unfavorable. It's favorable. Yes. Either from my cues because I'm not responding when I hear unfavorable, or from somebody said it's because the more actual number is lower than the less actual number. We would have expected 23,000 plus direct labor hours. We only used 22,000. We were extra efficient. We must have employed a bunch of Boise State students instead of a bunch of University of Idaho students. It's in my contract. I have to say that every once in a while. Yeah, we were more efficient than we thought. So okay. Nope. I put the parentheses in. So our standard quantity minus our actual quantity, all times the standard price, we were $22,000 more favorable in our efficiency because we had those Boise State students. All right, I know you. Some of you might have even been over there. You have people you know over there. It's okay. I don't really hate University of Idaho. All right. So, just for completeness, this nice quick question here. We want to know the part of the journal entry to record materials purchase. And it's really a direct materials price variance question because that's clearly the question we're running into here. That's the number we're running into here. So there's a journal entry that we're going to make, that we would make. Direct materials price. Whoops. When you purchase these goods, you're going to make a journal entry if you're using a full standard costing system, and you're going to debit something at the top. You're going to do something in the middle, either it's credit or debit to the price variance, and then at the bottom, you're going to be crediting something there. There, I think I said it right once I corrected myself. At the top, you're debiting. Where do you put the direct materials? In the direct materials, raw materials account. Represents the warehouse, basically. Okay, middle, we're going to credit or debit the price variance account. And at the bottom, we're going to credit some payable. Accounts payable. We owe them. Well, we owe money because we bought it. Oh, you could credit cash too if you're literally paying it in cash, sure. But usually we're going to talk about it being accounts payable. So I want to, this is a real simple question, but I'm going to review a couple points as we go through it. We don't have to do this to answer the question. So we know we're going to have a debit to direct materials. We know we're going to have a debit or credit, and that's really what the question is about. But I want to focus on these two right here. Accounts payable. The credit to accounts payable. Is that at full actual, quasi-budget, or at full standard? Do you remember? At full actual. Yeah. The second best joke of the class, which is, if you don't do that, it's called jail time. Okay, so we've gone through multiple crimes today. This class is a crime, professor. Yeah, I know. So, full actual, you want to record what you actually owe on the balance sheet. That's a pro tip there. So, our actual price times the actual quantity purchased. Yeah, let's put that in. And I just gave it away. We're going to use actual quantity purchased. When we do the price variance during the purchase moment, and the journal entry that goes along with that, we're going to use the actual quantity purchased, AQP. Okay. Later, when materials are used, you get the quantity variance, which sometimes is called the usage variance. Use the actual quantity used for AQ. All right, so our actuals are 10,200 times 0.52. That should be our credit to accounts payable. Our debit to direct materials is going to be half standard, because when we get to WIP, eventually we're going to be full standard, but we're going to go halfway there. We're going to be at standard price now, because that's what the price variance is. It's the difference between, we pull that one lever of price, from actual price to standard price. So now once we're past the price variance, we've recorded the price variance, our debit to direct materials is going to be at half standard. So it's still going to be the actual quantity purchased, because we haven't yet filtered through from actual quantity to standard quantity, but it's going to be multiplied by the standard price. So times 0.5. So 5,100. You can probably see from the gap that that's a $204 gap. So we know it's going to be C or D. And in order to get a balance, does it have to be a credit or a debit? It has to be a debit of 204. Exactly. All right, let's make it. Now, I did that the harder way. We could just as easily, or more easily, have said, if I can get in the right screen, DM price variance equals actual price minus standard price, all times actual quantity purchased. Fix the parentheses. And we could say, so it equals 0.52 minus 0.5. If I moved away. There we go. Times 10,500. Nope. 10,200. There we go. 10,200. Just copying over actual price, 0.52, standard price, 0.5, and actual quantity purchased, 10,200. So yeah, we get that number, and we could just as easily say, oh, well, it's positive. Positive variances are unfavorable. The variance count is an expense account. Higher expenses, it goes up with a debit. Higher expenses are unfavorable, so it's a debit to that expense account. We could just as easily get to that answer that way, or whatever memory kludges help you best to get there. But if you want to, you could solve it just by figuring out the other two parts of the journal entry and use it as a plug. I'll put debit. Make it clearer. All right, I dwelt a little long on that. Let's jump forward to a lovely mixed variance question. Let's see, is there an open answer anywhere here? Yeah, a mixed variance question that's open answer. Well, let's just try that. Get some open answer questions in here. All right, mixed variance, open answer question. All right, so we have online sales and mail order sales. Should have made it Dwight sales versus the website sales. That would have been better use of my test making time. In total, we made 10,000 sales. We can add these together, and we know we made 10,000 actual sales total. So total units of input. We have a mix. This is I'm trying to make sure I use the right terminology here, because this is one of the very few which is about a revenue variance. But it works the same. This is going to work the same. In just this aspect of it is going to work the same as if it were one of the cost variances. If it were chemical A and chemical B, and the direct materials variance, quantity variance, for example. We have a standard mix. Okay, so over here we're in the actual mix. And then we're going to have the standard price and then a subtotal. Okay. And then, just to keep things all in one screen, instead of extending to the right here, let's just put this down here. Standard mix here. And we're going to take these two and subtract them. Okay. If you recall, we would extend to the right, and this would be all the way over here, and we would subtract this and this. I'm just highlighting to get these two are the ones we're going to subtract to get our eventual variance. That should be a mixed variance. And we have standard price, 23 for online orders and 9 for the mail order. And the subtotals are just multiplying across. We can copy all that over. The only thing that we should be doing, because again, it was just one lever, we need to pull just one lever between the two that we're comparing, is just whether it's actual mix or standard mix. That's why it can be called a mix variance. So our actual mix is 4,000 over the 10,000 total, which is 0.4, versus 6,000 over the 10,000 total. So however you want to figure that, maybe you did it in your head just easy, just fine. That's more power to you. 4 out of 10 are online sales, and 6 out of 10 are mail order sales. That's our actual sales mix. Our standard sales mix is that 3 out of, looks like 3 plus 8 is 11. 3 out of 11 are online sales. I'll let the Excel, or Google in this case, do the math on that. And 8 of the 11 are mail order sales. So we can see right here, we did actual sales much higher percentage-wise through the online medium than we were expecting, which means we must have done fewer mail order sales than we were expecting. And given the fact that we earn much more on online sales, this is going to be a favorable variance. Great. Don't let that break your brain about the sign. Point is, we got a number. This is not asking for favorability. Don't worry about the sign. Just put that number in. This is the amount of our variance. Again, 99% of your questions are about cost variances, and cost variances, if the actual number is high, that's unfavorable. With revenue variances, technically, if the more actual number is high, that's good. That's favorable, because you have to reverse the logic, not because you have to reverse it. You have to reverse the logic because you want higher revenue, all things being equal. You want lower costs, all things being equal. Okay. Remember some things about mixed variance here? That's okay. Anything you want to look at real quick before we move on for mixed variance stuff? We can come back to things. We can. Yeah. Okay, so these are the things that it kind of gives us. Is the idea? Or one of these, is it asking one of these things, that question?
It's asking for direct labor variance.
You're saying it gave us this debit right here?
It debits the direct labor price variance for 1,075.
How much is the debit to WIP here? Okay. And what's the actual quantity and actual price?
The actual labor hours is 12,000, and the actual price is 12.
Okay. So what I'm trying to get you to do here is think through the journal entry, because it's going to have 4 components. These two, what can come from these the third part comes from multiplying these two. And then this fourth part, which is what I'm asking you for. All right, so we're going to be debiting WIP. We're going to be debiting or crediting, but in this case we debit direct labor price variance. Looks like 12,000, or no, it's 1075. You said, right? We don't know how much we're debiting or crediting DL quantity variance, and we're going to be crediting wages payable by the actual amount. So same jail time joke about that. You have to record what you actually owe employees at the actual amount. So 12,000 actual quantity of hours times $12 per hour. This is the actual amount right here. All right, so just by figuring out the plug here, the total debits we have in the journal entry right now is 126,075. Total credits is 144,000. So we're going to need extra debits. So first of all, we can change this to debit, to direct labor quantity variance. Maybe, I don't know if the question already asked that. Already gave you that. No, other way. And the debit is going to have to balance it. So it's going to have to be the 17,925. Is that one of the answer choices, or is it open answer? Or
Yes.
okay. Yeah. So since we know we're going to have to debit to that, variances. These variance accounts are expense accounts. They go up with the debit, meaning we have more expenses with this debit. So that means it's going to be an unfavorable variance. Yeah. Is that good for your question? That's good. Looks good. Yes. Yes. Yeah. So the answer, or the question was given you these various parts of the journal entry, just piecemeal. And then it was asking for this. You had to figure that out. Let's put that nice and red. There we go. If you open this on a mobile, it's going to blind your eyes. Yes, yes. Exactly. Yeah, it's unfavorable because it's a debit. So we can infer that at the very least, yeah. Okay. Good question. Just in case you're reviewing and saying, I don't remember us going over that. That's what that question is from. All right. Let's move forward. We did mixed variance question. Maybe we can do a yield variance question here. Oh, this is fun. It's either 100,000 or who knows. Although it's asking us this. That's interesting. Okay. Well, the yield variance is our actual yield minus our standard yield, in parentheses, all times the standard price at standard mix. So at any point, do we need the actual mix of inputs? The answer is no. So it can't be this answer. Even if we can't determine the answer to given these facts, it's not because of this. You would never need to know the actual mix of inputs to figure out the yield variance. Yield is still entirely in standard mix. We're just pulling the lever of actual versus standard yield. All right, so at the standard mix, the standard price of input units per finished goods unit is $100. Now, they don't tell us the standard mix, how much is A versus how much is B, but it's already given us that $100 that we would need to be calculating using that mix. Okay, so honestly, I'm leaning towards that not being the answer. I don't think that's going to be the answer, I would bet. I bet this $100 is going to be multiplied by 10,000 is basically what we're going to do. All right, so here's what we do. All right, yield variance question. And we need to figure out what the favorable or unfavorable aspect of it is. So we have standard price at standard mix of $100. I'll even put in here what I said verbally here. Yield variance equals actual yield minus standard yield all times standard price at standard mix. Okay, got that $100. That's that variable right there. We need to figure out our actual yield. We actually computed 10,000 units. Oh, that's actual yield. There we go. We actually yielded 10,000 finished goods units. Now, we have this expectation that for every 10 input units, we complete a finished goods unit. So the standard number of input units per finished goods unit is 10. And since we use 90,000 input units, we would expect 90,000 divided by 10 number of finished goods units. That logic makes sense, right? We use 90,000 units. We actually use 90,000 input units. We would expect the standard is that there are 10 input units that go into a single finished goods unit. So we should have 9,000 as our standard yield. Okay, so if we use this equation right here, our actual yield, and we got to put the parentheses in, our actual yield here minus our standard yield all times 100 gives us $100,000. So it's one of these two. Well, this is the tricky part for yield variances for a good number of students, and rightfully so. Is this favorable or unfavorable? Yes. Sorry, I had to think about it for a second. Yes, this is favorable. Yeah. Now you're programmed through every other variance. We don't even look at favorability with the revenue variances, so we'll exclude that. The only time I have it is in mixed variances, open answer questions where you don't have to figure out favorability. Every other time you have to figure out favorability in the exam or in the questions, a positive number is unfavorable because that means that the actual number, which is here, was subtracted away, which is larger than the more standard number, which is over here, because that's the way subtraction works. In this case, we're figuring out yield or finished goods that we produced with a fixed set of input units. And because we've changed that, we're going to flip what favorability is. I think I said it more succinctly back when we were in the chapter, but at the very least, remember, your signs are opposite in yield variances. You write down whatever you want to do, give yourself an example, and say, hey, here's this example. 10,000 actual yield, 9,000 standard yield, $100 means 100,000 favorable. Write that down in your notes if you really want to help, or something like that. So yeah, this 90,000 input units should have produced 9,000, but we were super effective with our efficient. We got 10,000 actual units out of that. 10,000 finished goods units out of those 90,000 input units. All right. All right, on to chapter 8 stuff. It's a good one because it asks you for COGS after backflush. All right, let's open that folder in our minds. We're using throughput accounting. What is which one category of costs is considered inventoriable under throughput accounting? Only direct materials. Yes, it's considered to be the only truly variable cost under throughput accounting. So just this right here, $15,000 divided by 5,000 units in total units. Let's put this back. Flush throughput question. $15,000, 5,000, that's DM cost. And that's total units, which means we divide those, and that's our cost per unit. All right. When we backflush costs, well, first of all, during the period we incur this $15,000 of direct materials, it gets debited to where? Where do we collect the costs under a backflush system before we backflush them out? Do we do the typical where, oh, we purchased some direct materials, so we're going to debit direct materials or raw materials account, inventory account, and then once we take them out of the warehouse, we're going to put it to the WIP account, and then, once we finish working on it, we're going to go to the finished goods account, and then finally, after those finished goods are sold, we're going to put it to the cost of goods sold account. That's the usual method. Under backflush costing, we don't do that, so the answer is no, we don't do that. Where do the costs go and live until we backflush some portion of them back to inventory accounts? Might be related to where this, Not the RIP account, no. But that is a new account we use. We will be backflushing to that account instead of like raw materials and WIP. We'll backflush to RIP. Where do we debit those costs first? The very end of that chain is the cost of goods sold. It's where we're collecting our costs. So during the period, we're going to be debiting that $15,000 to cost of goods sold. And then at the end of the period, or after the end of the period, we backflush a small portion back to the RIP account and finished goods. If we were using direct costing, we also might backflush this, whatever is reflected here, this amount, to cost or conversion costs. But we're using throughput accounting, so all we have to worry about is what's being debited to RIP for the raw and in-process portion, and to the finished goods account. All right, so we have 15,000. That's our starting point. And we can answer the question already. Because can backflush move that 15,000 up to 17.6 or 20 or 35.2? No. We are crediting away some of that cost of goods sold amount and debiting it over to RIP or finished goods. It has to be this number right here. How do we get that? If we didn't have the cheater way here of, by process of elimination, I know it's the case. Well, there are 100 units that are finished goods that we're going to be debiting to some costs to, and 500 units in process. And there's no portion for RIP. So we just have 500 IP and finished goods units to debit to, and the cost is $3 per unit. So $1,800 is the total credit to cost of goods sold in that entry where we credit the cost of goods sold and debit back to the RIP and the finished goods account. That's how you take this 15,000 minus that credit right there, and then we get our COGS after backflush, if I could spell it. Okay, yeah.
We did have raw materials you just added to the dip and finished goods unit, and then
Yes. Yes. So let's add that right here. So this is the portion. And in this case, it's 0. But our total credit to COGS he's going to have to include that. So yeah. Yes. Right there is me accounting for that now. Perfect. Okay. Am I correct when I said a while ago that as we get closer and closer to the present, more and more is ringing a bell? Like, oh yeah, this was 3 weeks ago instead of 6 weeks ago. Hopefully that's true. Hopefully it's not like everything past 5 minutes ago like falls off a cliff and I've forgotten it. I hope there's been some gradual increase of recognition as we've been going along. I feel that way sometimes. Okay, that's not a dig against anybody. Sometimes I'm like, how did I even get here? All right, I'm breezing past some of the chapter 8 stuff. Let's focus in on we'll make sure we get a service department cost allocation and a transfer price question. So I don't want to do maximum because who sets the maximum? The buyer department or the seller department? Just remember this. Put it on your notes if you don't remember. Seller's going to set the floor for it, the minimum. So it has to be the buyer department. Okay, so the buyer's going to set it. This question right here is as easy as looking at the buyer's external market price. That's the ceiling. Let's look for the floor. Oh, this is asking for a floor. So the seller's determining the floor. For negotiating price, the buyer's like, well, I don't want to spend over that. And the seller says, well, I can't accept any lower than this, or I won't make back my investment. So we have a ceiling of 125. We only need to know that because it's possible that there's no price possible. There's no transfer price possible. It's theoretically, that could be the answer here, if we have a floor higher than that $125 ceiling. All right? So let's go here. I stopped delineating chapters a while ago. Okay. I think it's fair that we're breezing through chapter 8 and 10, considering there are 3 and 3 questions each on the exam. All right. So let's see. We need to know floor. So price floor is going to be equal to fixed costs, which are going to be the fixed opportunity cost of accepting the buyer's demand. Buying department's demand, divided by the quantity the buying department demands, plus the variable manufacturing cost, internal variable cost, if you will. All right, so, well, first of all, they want 20,500 units. That's Q. We can only produce, without kicking out any regular external paying customers, 3,500. So the difference between these two is our lost unit sales. All right, we just a week or two ago. Last week, right? So now we need to figure out how much the unit contribution margin is for each of those lost unit sales. Okay, we can just do that all. I'm going to do this all in cell here, in the cell. We have the $148 we can sell it on the external market, minus the variable cost for those external sales that are specific to those external sales, $10, minus the variable cost to manufacture those units, and we end up with $63 in unit contribution margin. So multiply 17,000 units lost unit sales times the contribution of 63, and we get our total lost contribution margin from fulfilling the buyer's demand. If we take that and divide it by Q, we end up with, let's just do the whole shebang there. There we go. So this is F right here. I'll label it. The lost contribution margin, total lost contribution margin, the 1,071,000 right here, is our fixed cost for supplying the buying department. They're demanding this number of units. And we're going to add in 75, which is the variable manufacturing cost. That's V right here. So F over Q plus V, that's what this cell is doing, gives us 127.24. And this is not one of the answer choices, right? Or it's not. See, you got 75, you got 2022, you got 100. But this is the floor. And we had our ceiling. So is the floor higher than the ceiling? Okay, don't buy a house like that. Life lesson. Okay, that's the Jeep problem. Our Jeep is upside down problem, right? So that means economically speaking, we would not be able to figure out a transfer price in negotiations there. Great. Let's do step-down method. We'll solve for A to X, but I'll also show you what we would need to do. No, can't do that with this question. I will assume some percentages and show what we need to do if we needed to do B to X as well. All right, so here we have A to X. This is our step-down question. Up here was our transfer price question. We need A to X. Now, A is the first department in the step-down process. So A gets to allocate its costs to all downstep service departments and all production departments. So it just gets to use this raw 30%, this raw 35%, and this raw 35% to determine how much of its costs go to each of those. So I'm simply asking how much of B's costs here, so 173,814, go to X, which is going to be 35% of it. Don't overthink this one. It's there. That is A to X. What if it said B to X? And we're going to go ahead and assume that B, 20% of B's services go to A. 50% go to X and 30% go to Y. That totals to 1. Good, 100%. And let's give B initial costs of $100,000. So we need to do two things. First of all, we need to figure out A to B, because that initial 100,000 is going to be added to from A. Some of this A's cost is going to, some of the, I mislabeled it. There we go. There, now labeling's right. Some of this 173,000 is going to go to B, so we need to figure out how much of that goes to B. So we're going to take this 173,000 times what percent? How much service, how much of A's services are consumed by B? That's the other way. That's how much B services are consumed by A. It's in the problem here somewhere. Problem fact pattern. It's the 30%. Yeah. Good. So A is going to allocate 30% of its cost to B first. All right. So now B's new costs after the allocation from the top step service department. Now, B is going to allocate to any downstep service departments, of which there are none, and production departments. So it has to refigure these percentages. So out of 80%, 0.5 over 80. Here, I'll do it this way. This rings a bell. It's like the direct method, remember? This should ring a bell. We're refiguring this percent. This isn't 50% anymore. We are going to ignore this. We're going to act like this doesn't happen. Let's make it a lovely gray. It gets real light, real quick, just a little bit. You already noticed it. Sorry, random tangent. All right, so this 50% doesn't represent 50%. It's 50% of the total work done. But if we ignore the interdependency, we imagine that this doesn't happen. This is grayed out now. It's 50% out of 80% of the work. So that 0.5 over 80%, which is the sum of these two, gives us 0.625. That's B's, the percent of work done for X out of work done for production departments. So we can take the new costs times that 62.5%, and that should be our B to X. All right. Let's put our actual answer to this in. Let's check to make sure we got all the answers right that we answered. Double check on this. How many did we answer? It's like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, great. 10 out of 20 questions. We should get half the points right. 25 out of 50. Good, we got them right. Okay, good. All right. Well, I think that's an okay crash course in final exam material. It's not a comprehensive review. I'll be here for office hours on Wednesday and next Monday, and I'm happy to read your emails if you got specific questions like, I'm reviewing and I just can't remember this or whatever. Feel free to reach out. Thank you again, and have a good break.